In this video, we're going to discuss the stock market outlook for 2023. We're going to compare it to the bursting of the dot-com bubble around 2000, and also look at some comparisons with the inflation problems of the 1970s. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm also a chartered financial analyst and a certified financial planner. First topic we will discuss is how can a small investor outperform the stock market? Why not just buy an index fund and leave your money there forever? If we look at Wall Street, the idea of the efficient markets hypothesis is we have thousands of PhDs, CFAs, CFPs, MBAs, and all of their knowledge is embedded into the stock market. So the stock market itself could be reasonably efficient, and you as a small guy can't really find anything that they can't. Well, there are some reasons that this might not be completely true. One would be looking at small stocks. If you look at Wall Street, they have big investment funds. They really can only invest in stocks and take active positions in them if they're in billions of dollar ranges. So if you go to the low end of that, if you're a small investment management firm, and if you're a small investor, even stocks less than $1 billion, you could potentially find things that the big Wall Street guys don't because they're not going to be really looking at them. We're not going to concentrate on that much in this video. What we're mainly going to look at is long-term trends and behavioral finance. So the idea behind behavioral finance is people to some extent behave like lemmings. They follow a trend and they stick with the trend too long, even if it's irrational. And of course, if you're on Wall Street and your investors want you to invest in tech stocks, even during a tech bubble, you're still going to be selling tech stocks. To use the most recent example, and the same could go for a commodities bubble, a real estate bubble, all the other bubbles we have had throughout human history. So examples of people that just stick with the same idea throughout time would be Peter Schiff or Cathie Wood. Both are very well-known investment advisors. Peter pretty much always has taken the position that you buy gold and international stocks, the U.S. economy is going to collapse, we have too much debt. Very likely true in the long run, but it might not be true over a 10-year period. Cathie takes the position that tech is the future, always invest in tech. Well, technology is certainly what drives increases in standard of living over time, but that doesn't mean that tech stocks can't be overvalued. And we will try and look at how we would figure out how to follow trends and move back and forth, for example, between these two types of ideas, rather than just sticking with one idea permanently. Here is a graph of the price-earnings ratio of the S&P 500. This can come out of the form of the Shiller P/E, where you do a long-term average of earnings or an annual P/E. At the moment, this is actually looking somewhat more reasonable. We have came off what I would call a second dot-com bubble. Certainly P/Es are high if you look at like a 200-year trend, but if you look at the activism time period of the Federal Reserve since the breakdown of the Bretton Woods in the 70s, this P/E isn't terribly unreasonable. So stocks might be somewhat reasonably priced at this point if you're going to continue to have an active Fed that's in printing money, which is likely to be the case. It looks highly likely that we have an echo of the 2000 dot-com bubble. You see here the big peak in 2000 where we had a huge run-up in tech stocks, over-enthusiasm, and then it burst, and then everyone got out of the tech stock industry and hated tech for a while. And then, of course, we had it happen again in 2020. Same thing has happened, huge run-up in tech stocks. People have got out of tech stocks, and the bubble has been bursting. So if we look at the point of the bubble burst here, it's still a little over 1, and that would be around 2001 would be the equivalent point from the first dot-com bubble. And of course, between dot-com bubble in 2000 and the 2020 dot-com bubble, we had a real estate bubble, we had a commodities bubble, we had a lot of different activities going on that would have been better to invest in instead of tech. If we look at the time period for the next decade after the dot-com bubble, well, the S&P 500 wasn't a terribly good place to invest. We had the dot-com bubble here. It burst, bottomed right before the first Iraq war, and then the S&P went back up with basically the housing bubble, burst again in 2009, and you would have spent 10 years overall of making absolutely no money unless you had the sense of being able to switch from, we'll say, tech stocks, growth stocks to value stocks. Or another alternative that we will discuss quite a bit in here would be international stocks that did quite well during this time period. If you were just investing in the S&P 500 domestically, this would have been a time period that you might have been better off just investing in an equity indexed annuity. You would have got the upside and missed the downside. So during the various dot-com bubbles, tech was the future. Everybody wanted to invest in tech. Tech would go up forever. Now, on the other hand, tech is developing not so great a reputation. Certainly, there have been multiple fraud scandals, and then there's been the takeover of Twitter by Elon Musk, exposing a lot of the manipulations and censorship of Twitter. So Silicon Valley has gone from being the future to being somewhat questionable. And probably this attitude in people's minds will be dominant for the next few years, and then, perhaps people will be more enthused about tech again. So let's see what happened after the first dot-com bubble. So the tech bubble burst. At this point, I'm looking not at the top of the tech bubble, but a year after the peak of the tech bubble. So the area where the value to growth ratio would have been about the same as it is now, and looking out at the next year. So if the past repeats, this would be a good guess of what this year would look like. And what you saw then is, even a year after the burst of the tech bubble, the tech stocks, the growth stocks, continued to go down. Large cap growth went down by 20%. Small cap growth went down by 8%. The so-called value stocks, well, at least small and mid cap, got a positive rate of return of 12 and 5%. And large cap value went down still by another 5%. So clearly, even a year after the tech bubble, even after the ratios had gone down to close to 1 in value growth, you would have still been far better off in value stocks for the next year. If we look at the entire next decade, approaching, in this case, the peak that we would have called the housing bubble, well, value still outperformed growth, but it was more sector by sector. So you would have done extremely well in small cap value and mid cap value. Then actually mid and small cap growth would have been the next best performers, but large cap value would have drastically outperformed large cap growth, which did basically nothing for 10 years. So at least, again, if history repeats itself, in the U.S. domestic market, the place to be right now is in value stocks, not growth stocks, even a year after the bursting of the dot-com bubble. So in 2000, we had the bursting of the dot-com bubble. Between 2007 and 2009, we had the bursting of what would be called the housing bubble. So in 2000, we had a conversion of wanting to invest from growth stocks to value stocks. Value stocks drastically outperformed from 2000 to 2007, and then you had another bear market, and this bear market then caused yet another inversion of what you would like to invest in, and coming out of the housing bubble, you would have been far better off again in tech stocks, in growth stocks. So going from 2009 to basically the 2020 dot-com bubble number 2, growth stocks drastically outperformed value stocks. You got in small cap growth a 400% rate of return, 390 for mid cap, 364 for US large cap growth, and then value, small cap value is below that at 318, mid cap value 310, and large cap value coming at the bottom at 234. So what we can see is commonly in bear markets, you have a shifting of the leadership. And this could be from value to growth in the US, or it could also be, as we will soon see, from US to international, or from international to US. So right now, there are a lot of reasons to think that international investments would be better than US investments, again, in particular, US tech. One of the reasons is the price of international markets versus US markets. We can see here US PE under this particular measurement, forward PE ratios, is around 18, which is much higher than the European Union, emerging markets, even Japan, or the UK. So the red line here is the US. These are PE ratios as a function of year, and the US is definitely an outlier. It's way more expensive than the rest of the markets. And historically, this has not always been the same. The US might have been a little bit higher, but nowhere near the gap that you're seeing now. So international markets are much cheaper to purchase on a price-earnings ratio basis than US markets. This is a graph of the performance of the MSCI USA over MSCI World. So if it's going up, then the US is doing better. If it's going down, then international markets are doing better. And you can see here, since the bursting of the housing bubble, the US has done far better than international markets. But from the bursting of the tech bubble to the bursting of the housing bubble, international markets did much better. International markets also did much better in the 80s, and in fact they did largely better from when Nixon took the US off the gold standard until the late 80s. So in this time period, you would have wanted to be in international markets. Here you would want to be in US markets. Here you would want to be international. Here you would want to be US. Since we think things look like the time period from the bursting of the dot-com bubble, this looks like a good time for international investments. Another similar graph for emerging markets. Here we have emerging markets over the world. So when you are going up, emerging markets are doing better. When you are going down, other countries, particularly the US, are doing better. And again, from the bursting of the dot-com bubble to around the peak of the housing bubble, you would have been way better off in emerging markets. And from here, the late 80s up to 94, you would have been way better off in emerging markets. Once again, if things today are like they were after the bursting of the dot-com bubble, we think emerging markets and also other international markets are going to be the outperforming investments. A more detailed regression to the mean type argument is done by the excellent website Guru Focus. The website attempts to project future rates of return for the 26 largest economies in the world using three factors as follows. Future business growth. We assume that the average future growth will be the same as past growth, and this may overestimate growth for fast-growing economies. Dividends. They assume the average future dividend per year in the next 5 years will be equal to the average of the last 5 years, and they note this may underestimate dividend yield, as in general dividends will grow as economies grow. Also, change in market valuation. Big assumption here is the market valuation is the total ratio of market cap to GDP will revert to its previous mean during a full market cycle, which will last 7 to 8 years. Total investment return is then given by this equation. Investment return is dividend yield plus business growth plus change in valuation. They get the following results. Emerging markets, again, can potentially do quite well. Of course, there are risks in emerging markets. For example, if you had invested in Russia in, for example, RSX or RSXJ, that would have been locked up by the US government. But they certainly show that these markets, on average, should return at a much higher rate than developed markets. And in developed markets, the ones on this side, a lot of European countries and Australia, have a much higher return than, for example, the US, which doesn't look like it's going to get very good returns, and Japan, which looks to have abysmal and negative returns over the next few years. Yet another argument for international investment is most individuals in most countries tend to invest too much in their home country, a home country bias. So most Americans have most of their money in the United States. Well, by GDP, the US is now only 24% of the world economy. So having a large fraction of your money in only 1/4 of the world's economy is actually a pretty risky thing to do. If we look at the same sort of analysis by global equity markets, the US is a much larger portion of the global equity market, but it is still less than 50%, only 46. More things in the United States are securitized than in the rest of the world, but also the US market cap to GDP ratio is much higher than the rest of the world, which is another indication the US is probably overvalued, and you would be pretty good off diversifying in a lot of these other economies. There are multiple mechanisms for investments. Some of the cheapest funds, of course, come from Vanguard, and these are an example of Vanguard funds. They have VT, which is a global fund that is still 62% in North America and 59% in the US. But if you just invested in that, you would at least have 40% of your money spread out in the rest of the world. And the top countries in this fund would be Japan, UK, China, Canada, France, Switzerland, Australia, and also, well, the next largest chunk after North America is Europe. You do have a decent amount of money, 11% in the Pacific region and 10% in emerging markets, and even 0.2% in the Middle East. If you want to do region-specific funds, they have VGK, a European fund. The largest investment is currently in the UK at 25%, followed by France, Switzerland, Germany, Netherlands, Sweden, Denmark, and Italy. They have a VPL fund, which is an Asian fund, and it's over 50% in Japan, followed by Australia, South Korea, Hong Kong, Singapore, and New Zealand. And then one of my favorites, WVO, which is an emerging markets fund, around a third in China, 17% India, 16% Taiwan, 6% Brazil, 4% Saudi Arabia, 4% South Africa, 3% Thailand, and close to 3% in Mexico. The way I'm positioning a lot of my own money and recommending is as follows. I've got about half my money in the United States. I am overinvested in value funds, have close to nothing in growth. I may change that within the year. And I am overinvested versus the base in mid and small cap funds versus large cap funds. So the base of using VT of basically the world equity markets would be 26% in US value. I'm only 20% in that, but I'm 15% in mid-cap value and 15% in small-cap value. I currently have almost nothing in US growth. If you were directly following the index, you would have this. I am overweighted in Europe, 20 versus 16%, about equal weighted in the Pacific and overweighted in emerging markets. So roughly half international, half domestic, and the US portion is only in the growth sector. We believe 2023 will be a pretty good year for the stock market, both domestic and international. One of the primary reasons for this is presidential election cycle theory. If we look at the S&P 500, since 1933, it tends to have done the best in the third year after a presidential election cycle. All of the years are positive, but the third year massively outperforms. There are a lot of theories behind this. Generally, in the third year, presidential primaries begin. The party in power wants to get reelected, and therefore they will do whatever they can to keep the economy in good shape from basically the third year up through the presidential election in the fourth year. So we would expect, at least by the end of 2023, the S&P to have done reasonably well, and that to continue into 2024. 2025 is another question. How does the government do this? Well, the central bank, of course, can inflict a lot of damage to the stock market by raising interest rates, or they can make the stock market go up quite a bit by lowering interest rates. Not always, but during most time periods, they tend to only fight inflation in off-election years. So the Fed has raised interest rates a lot recently, 25 basis points just last week. But now it seems like they're not going to do drastic increases, no more 75 basis points or 50 basis point increases, but only maybe a few more 25 basis points for the rest of the year. They're going to moderate their increases, which probably will not scare the stock market that much in 2023, and there's a good chance of a decent stock market recovery. The time period that this behavior was most dominant was back here in the 70s, where you can see they raised rates to fight inflation in off-election years. They lowered them around presidential election years. They raised them again in off-election years, lowered them in presidential election years. And one of the big changes of that would be during this time period when Jimmy Carter appointed Paul Volcker to the Fed, and he massively increased interest rates as Jimmy Carter was running for re-election. Carter may have been altruistic, or he may not have understood the Fed, but of course Jimmy Carter was not re-elected when the Fed fought interest rates during the run-up for the 1980 election time period. Looking at presidential election cycle theory in a little bit more detail in the 70s, we have, of course, Richard Nixon running for re-election in 72. Well, during that time period, the stock market went up relatively drastically from mid-1970 until after that presidential election. Then the Fed again started fighting rates, and the stock market dropped drastically into late 1974, at which time the Fed cut interest rates again, just in time for the 1976 re-election campaign of Gerald Ford, at which time the stock market went up a lot. That did not help Gerald Ford. Jimmy Carter was reelected and stayed in power until 1980, when, as we mentioned, he lost to Ronald Reagan, and the Fed did not follow the standard policy of lowering rates for the election. Well, let's see what's happened so far in this cycle. This is a graph of 2022 to around today. We basically had two market bottoms in 2022, one in June and one in October. We think it's likely that the October bottom will be a multi-year bottom. If you do see another bottom in 2023 near that, I would consider that a buying opportunity. And here we show the performance of all the various investments we have looked at during this time period: the S&P 500, Europe, Asia, emerging markets, U.S. large cap value, mid cap value, and small cap value, U.S. large cap growth, mid cap growth, and small cap growth. On the next graph, we look at what has happened since that bottom in October of 2022, and so far what we predicted has largely taken place. So the best performer here up at the top is VGK, the European stock market, which is up 32% from the market bottom in October, followed by our green and purple lines here, VPL, which is Asia, which is up significantly, and our light green line, VBR, which is US small cap value. And the bottom performers have been, in fact, the growth sector, the worst being large cap growth, large tech stocks, although, well, they have done badly since the bottom in October. They sort of bottomed again right at the beginning of 2023. So far in 2023, they have been performing very well. I think it's unlikely that will continue. You had counter trend rallies in growth of roughly 2 or 3 months maximum length after the bursting of the dot-com bubble in 2000. I think that is likely to be the case, and I think it is likely that the international stocks and the U.S. value stocks will outperform tech, but one can always be wrong, and at least the January time period has been very good for U.S. tech. Now that we've looked at equity investments, both after the dot-com bubble and in the last few years, as well as a look in the 1970s, we will examine the performance of other investments, starting with real estate. If we look back here around the year 2000, real estate was relatively reasonably priced. It had not gone up significantly really since the 1990s, and as people moved out of dot-com stocks, they needed another bubble to invest in, and real estate did extremely well, with prices nationwide overall over doubling from the year 2000 to the peak of the so-called real estate bubble, which was also the peak of the stock market in the value stocks at that time. People at this point in time made comments like home prices never go down. As the stock market burst again around 2007, and you had a bear market to 2009, the real estate market burst as well, and of course we had a lot of defaults on home mortgages. So unlike the first dot-com bubble, the second dot-com bubble in 2020 is sometimes called the everything bubble. So during the first dot-com bubble, real estate was reasonably priced and went up afterwards. During the 2020 dot-com bubble, real estate went up just like tech stocks went up. Given that, we don't think that this is a terribly great time to invest in real estate. We think there will be somewhat of a pullback, although nothing like was seen from 2007 and 2009. 2007 to 2009, lots of people defaulted on their home mortgages. At this point, there is plenty of equity in people's homes, and mortgage defaults seem unlikely. Just like real estate, oil did not go up a lot during the first dot-com bubble in 2000, but skyrocketed afterwards, peaking at 140, an increase from below $20 a barrel, at the same time of, in a sense, the value stock bubble and the real estate bubble of 2007. With the recession then bursting, it dropped back to around $40 a barrel and has bounced around since then. Well, in the last year, oil prices did go up above $100 a barrel. They are back around 76. They are certainly well above the lows of 20, but they are not unbelievably high priced, sort of in the moderate range in the post-2000 era. So we think that oil, while not a great investment, will still probably do reasonably well, and therefore in 2023, oil stocks will probably do okay. Over very long time periods, gold and silver basically behave like cash. In recent years, they have been a hedge against inflation, and of course, with the Federal Reserve printing money, the value of cash has gone down. So gold and silver have certainly been a better investment than bonds or US dollars, but basically they've been a hedge against inflation. So they've essentially kept their buying power for the last several hundred, if we go back to the Roman Empire or the Greeks, several thousand years, but they haven't got an extremely high rate of return. We see gold here in gold, silver in sort of the silver color, And then our top two lines up here are the S&P 500 and the Dow Jones Industrial Average. And clearly you would prefer to have this massive rate of return shown in equities from 1896 to today than this basically keeping pace with inflation return down at the bottom. So over the very long time period, gold and silver are more like insurance products. I would rather have my money in those than cash, although you need cash to be able to buy things. Over shorter time periods, of course, gold and silver have done quite well. Again, after the dot-com bubble, stocks didn't do terribly great. Certainly tech stocks did badly. And then you had a good rate of return in value stocks. But you actually, after the bursting of the dot-com bubble, had a tremendous return in gold and silver. They outperformed significantly the U.S. stock market, actually to the point that you would have been better off over the last 20 years in gold and silver than equities, which is very unusual. Of course, since they have done that well in the past, and again, as they went up here around 2010, they've gone up some recently. I would consider them okay investments and basically insurance products, but I wouldn't put a ton of money in gold. We can further look at the relationship of the valuation of gold versus stocks in a graph that looks like this, which is the Dow Jones over gold ratio log form since 1792. Generally, we have an upward slope, as we would expect. Gold only stays consistent with inflation. It's a medium of exchange. Stocks should go up in price over time as technology gets better and companies become more and more efficient at producing things. So we should have an upward slope. During time periods like this, the stock market boom from that went up and maxed in 1929 and then went into the 1929 to 1933 Great Depression bear. You can see at that peak, stocks were overvalued versus gold. Before the Nixon shock, when Nixon defaulted on the gold standard, defaulted on the Bretton Woods Agreement in '71, then stocks were certainly overvalued versus gold. And at the peak here of the dot-com bubble, stocks were overvalued versus gold. Whereas the gold peak here, gold was certainly overvalued, and one can argue gold was overvalued here. We're roughly in the middle now, so probably gold is at a reasonable valuation, an okay buy, but not a great buy. If we compare gold to other potential non-equity investments, for example, real estate, here we have the Shiller Case Home Price Index divided by gold ratio. Well, we believe real estate is somewhat overpriced, but compared to gold, it seems to be at a low price. So this would indicate actually gold is rather overvalued. So down here, gold would be at extreme valuations. Up here, real estate would be at extreme valuations. We can also look at a ratio of oil to gold going back to around 1950. In 2008, certainly oil was overpriced, as it was a few years before that at the high extremes, and down at these extremes we would expect oil to be underpriced versus gold. Well, at this point, oil looks at the lower level versus gold. That would indicate that either oil is underpriced or probably gold is overpriced. So I would prefer oil as a commodity investment over gold. Copper to gold ratio enforces the same thing. During time periods at the top here, back in the 1800s, copper was way overpriced versus gold, whereas down at these bottoms, you would consider gold to be overpriced versus copper. Right now, copper looks cheap versus gold. This graph shows the historic gold to silver ratio since 1693. During most of this time period, both the U.S. and the world were on a gold standard with a set ratio of gold to silver, such that 1 ounce of gold was worth 15 ounces of silver during much of this time period, 1792 to 1833, which was increased to 16 ounces of silver worth 1 ounce of gold in 1834. This system stayed in place until around 1873, when silver was demonetized and the U.S. went on a pure gold standard. Then the price of silver was allowed to fluctuate versus gold, and you can see the price of gold went up relative to the price of silver. The Federal Reserve was created in 1913 and started to wreak havoc with the gold standard, even though they were still supposedly on it. The Fed printed too much money, and it was not really backed by gold, even though it was officially, and the U.S. government defaulted on the gold standard domestically in 1933 when Roosevelt made domestic gold ownership illegal, seized most of the gold from banks, and put it in the Federal Reserve System. Gold skyrocketed in price on the world market, peaking around 1940. After that, you can see the gold-silver ratio went down. You had some chaotic periods. You had the Bretton Woods Agreement. And then after that, Nixon defaulted on the international gold standard of Bretton Woods in '71, and we got to the point where gold fluctuates versus silver. If we look throughout these time periods, again, we see gold seems to be at a relative peak versus silver, which would once again instigate that gold is not that great of a commodity investment at this time, and silver would be a better commodity investment. So if we were going to invest in commodities, we would prefer oil, silver, or copper over gold, and actually probably we would also prefer real estate over gold. I used a large number of excellent references in producing this presentation. Investopedia has lots of general information about stocks and investments, and we reference their section on presidential election cycle theory. Much of the graphs on equity and index fund performance came from Yahoo Finance. The Fed funds rate, of course, came from the Fed's own site. I already discussed the Guru Focus site that does excellent economic analysis, and we use their valuation of domestic versus international markets. Many of my graphs came from the Long-Term Trend site that does excellent comparisons of ratios of multiple different asset classes. Some of the analysis of the comparisons of the size of domestic versus international markets came from this site. The Vanguard site, of course, did the analysis of what the Vanguard funds are invested in. World Population Review gave us the size of each of the countries in the world via GDP, and Yardnelli Research did an excellent analysis of the relative P/E ratios of countries and regions. I thank you for watching this video.